Usually when we talk about like a medical diagnosis, there's this expectation of absolute precision.
Right, yeah, a clear-cut answer.
Exactly. Like you break your arm, the x-ray shows a jagged white line, and the doctor just points to it and says, there is the problem.
It's totally visible. It's categorized. The mechanics of the problem are right there in front of you.
Right. It is a binary reality, but when you step into the world of financial markets, and specifically the options market, I mean, that x-ray machine seems completely broken.
Oh, totally.
We are looking at a diagnostic landscape that is just incredibly murky. Most people are out there staring at price charts, drawing these, technical triangles.
Obsessing over moving averages.
Exactly, and just trying to predict the future direction of a stock. And in doing so, they're completely missing the one invisible, absolute force that is actually dictating their fate.
The underlying math.
Yep. So welcome to today's deep dive. If you're listening right now, you are pulling up a chair at our table to look at a mechanism that, honestly, most traders treat as a total afterthought.
Which is wild, but true.
It is. We are stripping away the usual noise of chart patterns and market predictions to examine a single, incredibly powerful control dial in options trading. It's called DTE, or days to expiration.
It is, without a doubt, the absolute master lever of the entire options pricing model.
It really is. And the insights we're working through today, they come from a detailed breakdown on how DTE is the underlying driver of consistency, regardless of whether you are stepping into the market as an option buyer or an option seller.
It impacts both sides just as heavily.
Right. Now, before we get into the heavy mechanics, I need to state very clearly for you listening, this deep dive is not financial advice.
Standard disclaimer.
Yes, strictly for educational and mathematical value. All option strategies involve risk, and you always need to make your own informed decisions. But with that established, okay, let's unpack this.
Let's hear it.
We have this landscape where traders focus obsessively on price, predicting if the stock goes up or down, but they pick their expiration dates almost arbitrarily.
Like throwing darts.
Exactly. Some pick Friday because it's close, some pick next month because it feels, safe.
Well, what's fascinating here is that when you trade an option, you are not actually just trading price.
Right.
Price is only one dimension. You are literally trading the physics of time. And time controls two massive, fundamentally opposing forces in this arena, Theta and Gamma.
Okay, let's define those structurally, because we hear these terms, the Greeks, thrown around constantly.
Right. Everyone loves to talk about the Greeks.
But let's ground them in the actual mechanics of a trade for a second.
Absolutely. So the Greeks are basically just the mathematical variables that price the physical reality of the option. Theta represents time decay.
Okay.
It is the exact amount of intrinsic value an option loses every single day, simply because the clock is ticked forward.
Just burning away.
Right. Gamma, on the other hand, is about acceleration. So if delta is the speed at which an option's price changes relative to the stock, gamma is the acceleration of that speed.
It's the multiplier.
Exactly. It measures how violently an option's sensitivity to price changes as the underlying stock moves.
Okay, so if I'm thinking about this right, if you are the buyer of the option, Theta is essentially like paying daily rent on an apartment that you are desperately hoping goes up in value so you can flip it.
That's a great way to put it.
Like you are bleeding a specific amount of cash every single day you hold that contract. But if you're the seller, you're the landlord. You have the structural advantage of just sitting back and collecting that daily Theta rent.
That maps perfectly to the mechanism, yeah. And the dynamic flips entirely when we look at gamma.
How so?
For that buyer paying the daily rent, gamma is their structural ally. If the stock moves in their direction, gamma acts as a multiplier, compounding their gains rapidly.
I want the acceleration.
Yes. But for the landlord, the seller collecting the rent, that same gamma is a constant looming threat.
I mean, I understand the definitions, but I have to, push back on the premise here a bit.
Sure.
If I'm a trader, my ultimate goal is to capture a directional move.
That's usually the goal, yeah.
So if I do my research and I know a stock is going to break out and run up 5% this week, why do I really care about the physics of time? I mean, price pays the bills.
Right.
If I get the direction right, shouldn't the time decay just be a minor cost of doing business?
Because the math of the pricing model does not care about your directional research.
Really?
At all. This is exactly how traders blow up their accounts while being fundamentally right about the stock. Let's say you buy an option, expecting that 5% move. The stock does move up, but it takes 4 days instead of 2.
Okay.
You look at your account, and despite the stock climbing, your option is actually worth less than what you paid for it.
Because the rent was higher than the appreciation of the property?
Exactly.
Yeah.
The Theta Decay ate the contract from the inside out while you were just, sitting there waiting for your thesis to materialize.
Wow.
The pricing model operates on a principle related to the square root of time. Decay is not a straight line. It accelerates.
Speeds up.
Yes. If you ignore where you are on that timeline, your directional edge is completely neutralized by the mechanical decay of the asset. You are right about price, but you are on the wrong side of the clock.
Which means we really need to look at how this clock actually operates across different time frames.
Definitely.
The source breakdown maps out the edges of the spectrum, the extremes of DTE. Let's look at the mechanics of 45 DTE first.
Okay, the longer time frame.
Yeah, the conventional wisdom in a lot of options education says this is the safe harbor because of that slow time decay. But when I look at the capital requirements, it just seems incredibly inefficient.
Well, it is a zone of immense stability, but you are right to point out the capital drag. Let's look at the mechanics. At 45 days to expiration, you are basically buying breathing room.
Right.
The theta decay curve is very flat out there. If you buy a 45 DTE option and the stock chops sideways for 10 days, you lose very little value to time. You have a massive runway for your thesis to play out.
But buying that much time requires significantly more upfront capital. You are paying a massive premium for that runway.
You are.
And because you are so far out in time, your gamma is practically non-existent. You don't get any acceleration. The stock moves, but the option price barely reacts.
Right. And for the option seller, 45 DTE provides what we call a wide defensive moat.
A moat.
Yeah, because those longer-dated options hold so much time premium, a seller can choose strike prices that are very far away from where the stock is currently trading. A sudden 1% drop in the market barely registers because the gamma risk is so low. The shock-absorbing capacity of the contract is huge.
But here's my issue with the 45 DTE strategy for sellers. Tying up capital for a month and a half to collect a slow drip of premium seems like a terrible use of margin.
It's a drag.
Yeah, the capital velocity is practically zero.
That is the exact trade-off. You are trading capital efficiency for a high win rate and low volatility. You lock up margin for weeks, waiting for the very slow mechanics of theta to finally erode the option's value enough to take a profit.
Here's where it gets really interesting, though. If capital velocity is the ultimate goal, why wouldn't a trader just operate entirely in the 0 DTE or 10 DTE space?
Right, the short term.
Because we see this massive volume of retail traders playing inside of one wick or even same-day expirations. You get in, you get out, the leverage is massive, and your capital is freed up instantly.
It looks appealing.
Right, so to use an analogy, 45 DTE is like steering a massive cruise ship. It's safe, but very slow to turn. While 10 DTE is like driving a speedboat through a minefield blindfolded. Why is that considered such a toxic environment if it solves the capital velocity problem?
Because the physics of the pricing model fundamentally break down and go exponential inside of that 2-week window.
Exponential.
Yeah, you are no longer trading a directional thesis. You are trading pure gamma. Let's look at why that happens mechanically.
Okay.
As an option gets closer to expiration, its probability of finishing in the money stops being a gentle slope and becomes a binary cliff. It is either going to survive or it is going to go to zero.
So the X-ray machine suddenly turns into a coin flip.
Exactly. And because the time remaining is so short, the market makers who price these options have to violently adjust their hedges with every single tick of the stock.
And that's gamma.
That violent adjustment is gamma. For an option buyer, these short duration contracts are incredibly cheap, which gives you that high leverage you mentioned. If the stock rips your way instantly, the gamma multiplies your gains at a staggering rate.
But the theta decay is operating at maximum velocity, right? Like if the stock just stalls for a few hours, the contract just evaporates.
It evaporates completely. But the real danger is actually on the sell side. The source material refers to selling 10 DTE option as stepping on a gamma landmine.
Okay, walk me through the mechanics of that landmine. Okay. Because on paper, selling a 10 DTE option looks incredibly attractive.
It does.
The theta decay is steepest right at the end, so you are collecting that rent at the fastest possible rate. Why is it a landmine?
Because inside of 10 days, the option has zero shock absorbing capacity left. At 45 days, the option has a wide base. Think of it like a pyramid.
Okay.
At 10 days, you are balancing a heavy plate on the tip of a needle. Any slight vibration causes it to fall. If you sell a 10 DTE option, a sudden 1% adverse move in the underlying stock doesn't just put a linear dent in your
It
profit.
blows it up.
Yes. Because of extreme gamma, that 1% stock move forces a massive repricing of the probability, expanding the option's value against you by 300 to 500% almost instantly.
Wait, really? So you could be collecting a few dollars a day in Theta rent, and in a matter of like 20 minutes, a minor market pullback forces you to buy the contract back for 4 times what you sold it for.
Yep. The acceleration works entirely against you. You have very little time and therefore very little distance to recover.
Wow.
If we connect this to the bigger picture, you can see why neither of these extremes functions as a viable foundation for a long-term systematic approach.
It makes sense.
The 45 DTE zone traps your capital and drags down your overall portfolio velocity, while the 10 DTE zone subjects your portfolio to structural landmines that will inevitably wipe out months of gains in a single afternoon of volatility.
So you're either moving too slowly to beat inflation, or you are strapping yourself to a rocket with no steering wheel.
Exactly.
So there has to be a structural middle ground, right? The breakdown points to a very specific quantitative sweet spot to balance these two opposing forces.
Yes, the data consistently points to the 14 to 21 DTE window, with a highly optimized center of gravity right around 17 to 19 days to expiration.
17 to 19 days. Okay, let's look at the mathematics of why that specific window works, starting from the seller's perspective. How does 18 days solve the problem of capital velocity without triggering that gamma landmine?
It is all about the slope of the theta decay curve. We talked about how decay is not linear. It relates to the square root of time. If you chart it, the curve is relatively flat out at 45 days. But right around day 21, the curve begins to steepen significantly. By day 18, you are entering the steepest part of the slide.
Okay, so for a seller, entering here means you immediately capture high-velocity time decay.
Exactly. You aren't waiting weeks for the premium to erode. You can often hit your profit target in just 5 or 6 days.
But you are still just far enough out from expiration that the needle hasn't gotten too sharp. Like, you still have a base.
Precisely. The gamma risk hasn't gone exponential yet. You capture the accelerated rent collection, but you maintain enough of a physical moat that a sudden market dip won't instantly blow out the position.
And what about the buyer? If I'm buying options, why wouldn't I just buy the 45 DTE for safety or the 0 DTE for leverage? Why is 17 to 19 days the sweet spot for deploying capital on a directional thesis?
Because it offers the most capital-efficient swing trading window. A 17 to 19 DTE contract requires significantly less capital than a 45 DTE contract, so your leverage is improved. But structurally, it gives you 2 full weeks of actual market trading days for your directional catalyst to fire.
Right, because 2 weeks from a 19 DTE entry puts us at 5 DTE. And this is where the breakdown establishes an absolute non-negotiable rule for this system.
Yes, the unifying rule, regardless of whether you are long or short, buying or selling, is you do not hold contracts into the final 4 to 5 days before expiration.
Never.
Never.
But why does the discipline mandate an exit at 5 DTE? I mean, if I'm selling an option and it's decaying fastest in those final 5 days, why wouldn't I want to hold it all the way to 0 and collect every last penny?
Because in that final week, the pricing model decouples from normal market behavior. The gamma and theta distortion completely takes over.
It gets chaotic.
Extremely. A stock can move 2 cents, and the option price wildly swings. It is pure noise. If you hold into that final week, you are no longer trading a structural edge. You are just gambling against the chaotic hedging algorithms of market makers.
So what does this all mean for the architecture of a trade? Is the goal here basically to hit an extraction ramp, like a planned bank heist?
I love that analogy.
Yeah, we use the 17 to 19 D2C window to get in. We capture the accelerated premium if we're selling, or we get our capital-efficient price move if we're buying. And then we hit the extraction ramp. We get the getaway car out of the building before the alarms start sounding in that final 5-day expiration week.
That is the exact mechanism. The 17 to 19-day entry is purposefully designed to enforce a short, mathematically predictable holding period. You execute the objective, you take the calculated profit, and you remove your capital from the table before the physics of the market turn chaotic.
Okay, so the 14 to 21 DTD sweet spot, targeting the 17 to 19-day entry and ruthlessly taking the money and running before the 5-day alarms go off. In theory, that makes total sense.
Right.
But we need to transition to the portfolio level, because knowing this window is one thing, but applying it to a broader trading system is where most people fail. Right now, a retail trader's portfolio usually looks like a chaotic mess of different time frames.
It really does.
Yeah.
The most common error in options trading isn't just picking the wrong direction. It is constantly mixing durations within the same portfolio.
The breakdown highlights this specifically, like A trader might buy a 40 DTE call on a tech stock on Monday, sell a 7 DTE put on a bank on Wednesday, and then throw on a 14 DTE straddle on an index on Friday.
Right, and they think they are diversifying.
But structurally, what they're actually doing is creating an unreadable mess of conflicting Greeks.
Exactly.
Remember, the Greeks are just the physical laws acting on the contract. If you mix all those durations, you have different thetas ticking at totally different speeds. You have gamma profiles reacting completely differently to the exact same market movement.
It's impossible.
You cannot possibly manage that portfolio mathematically or even hedge it effectively because every single position is operating under a completely different set of physical laws.
Yep.
It's like trying to bake a cake, a roast, and a souffle in the exact same oven, all requiring different temperatures and different bake times, and then wondering why the whole thing is ruined when you open the door. It's structural chaos.
That's a perfect way to visualize it.
But if mixing durations is the problem, I want to explore the solution. How exactly does standardizing your time, saying, I will only trade the 14 to 21 day window across my entire portfolio, actually remove the guessing from a trading system?
Well, this raises an important question, and it strikes at the core difference between discretionary amateur trading and professional systematic execution. When you strictly standardize your DTE window, you transform your portfolio from a guessing game into an orderly mathematical assembly line.
Walk me through the mechanics of that assembly line. What happens to the portfolio when every trade enters at exactly 18 days?
First, it gives you predictable pacing and allows you to stagger your risk. Because you know exactly what your time horizon is, you can deploy your capital in structured tranches.
Okay, so you're not all in at once.
Right. You aren't dropping all your margin into a single expiration date and hoping the market cooperates that specific week. You can open one trade on Monday, another on Wednesday. They all have the same lifespan, but they mature sequentially.
So you are basically smoothing out the portfolio heap.
Exactly. Second, standardization allows for entirely mechanical order management. This is where the real edge is found.
Mechanical, meaning automated.
Yes. When every position begins within the exact same physical time frame, your exit rules can be programmed with absolute mathematical consistency. You can use good till canceled, or GTC orders, to automate your profit targets.
Because the math behaves the same way every time?
Precisely. You know that historically, by day 10 of holding an 18 DTE short put, the Theta Decay should have eroded 50% of the premium.
Right.
If it haven't, or if the underlying stock has breached a specific technical level, your rules tell you to exit the trade. There's no emotion, no staring at charts hoping it turns around. You are simply managing the inventory on the assembly line based on its time in the oven.
It just removes the paralysis. If we know the extraction ramp is at 5 DTE and we reach that day without hitting our profit target, the decision is already made. We cut the trade. We don't hold it into the minefield hoping for a miracle bounce.
Right. And finally, standardizing time gives you clearer expectancy. When you stop fighting the clock, you can actually measure your edge.
Because you have a baseline.
Yes. You know exactly how fast time will decay across your entire portfolio.
Oh,
You know how much adverse price movement your contracts can absorb without a gamma explosion? You align yourself with the one truly immutable variable in the market.
Which is time.
Exactly. Stock prices are fundamentally chaotic. Earnings can surprise, macro events can shock the system, central banks can change policy, but tomorrow will always be tomorrow. The clock always ticks at the exact same speed.
Time is the only absolute guarantee. That is profound when you really step back and look at it.
It really is.
So for you listening, as we synthesize all of this, the core takeaway is a massive paradigm shift in how you view the market. By understanding how theta and gamma actually function, how the mechanics of decay and acceleration impact your specific side of the trade, you can stop being a victim of the clock.
Use it to your advantage.
Right. By utilizing that optimized 14 to 21 day sweet spot, you capture the ideal slope of the decay curve while maintaining your structural moat. And by ruthlessly hitting the extraction ramp before that final, chaotic 5-day week, you can tame the inherent noise of options trading and turn it into a mechanical, repeatable assembly line.
And that leads to a final lingering thought I want to leave you with, something to deeply consider as you look at your own strategies.
Let's hear it.
We spend so much energy, so much intellectual bandwidth and capital trying to predict the unpredictable. We obsess over whether a stock is going to move up, down, or sideways. But what if the ultimate edge in the financial markets isn't about predicting price at all?
That's a wild thought.
If you perfectly standardize your time horizons and you master the mechanical decay of the clock, could you build a system that is consistently profitable even if your directional stock picks are wrong half the time.
It fundamentally flips the script on what trading actually is.
It makes you wonder, who really controls the architecture of the market? Is it the forecasters desperately staring at their charts, trying to guess the future? Or is it the timekeepers, quietly managing the mechanical decay of the present? We talked at the beginning about how an X-ray machine doesn't exist for stock prices. You will never get a perfectly clear picture of where a stock will be next Tuesday. But if you shift your entire focus to managing DTE, you might just find that time is the only X-ray you ever really needed.